Hey everyone, hey traders. Let me know in the chat if you can hear me and see the screen. I'm very happy to welcome you at the first series of our marathon of webinars. And my name is Anastasia. I'm going to be your host for the next 7 webinars in a row. I've been trading since I'm 17 years old. Right now I'm 26 years old. And during this past 8 years, I've tested, rejected, and built and rebuilt my own trading system in multiple ways based on volume, market logic, and market auction. Right now, occasionally also teach other traders the very things that I use myself every single day. No fluff, just market logic and price behavior, which is going to be the topic of our webinar. Today, we'll begin with one of the most important and fundamental topics, the one that you simply cannot afford to not understand. And that's market mechanics through the lens of the order flow. Even if you've been trading for a while and you have your trading system that's been working for you already, you've probably noticed that traditional technical analysis and traditional candlesticks and indicators often lag behind and give you the analysis and entry points way too late. And they sometimes don't give a clear picture of why the price actually moved the way it did in a certain way. And in this webinar, we are going to talk about the principles of price formation, the physics of money, and how the market really works. I'll show you what lies behind the price movement, who actually moves the market, where you can spot the actions of large market participants, and how to distinguish aggression from passive order flow. We'll break down 3 powerful tools that are going to give you access to inner workings of the market, which is going to be the depths of market, the footprint charts, and the smart tape. So we'll compare all these tools as well, but to get started, we are going to truly understand what's happening in your order flow and your volume profile charts for those who use it. And the first thing that we're going to be needed to grasp today is the one fundamental principle, essentially the difference between passive and aggressive market participants. By the way, if you have any questions, if some questions going to appear during our today's webinar, please leave them until the end. Of course, you can tag them also in the comments, but all the way in the end of our today's session, I'm going to leave 10-15 minutes for the questions and answers. So I'm going to be tracking the chat down from time to time, but the majority of your questions are going to be answered all the way in the end of today's webinar. So don't worry, all your questions are going to be answered fully. Okay, so again, the topic of today's session is right in front of you. And the first is the physics of money. Let's talk aggressive and passive order flow. So we have 2 types of orders as well as 2 types of market participants in our market auction. The passive market participants, which you see on the left side of the screen, are traders who place their trades using limit orders. In other words, they place a buy or sell order at a specific price level, and they wait for the market to come to them. They don't chase the price, they patiently sit away and wait for the trade to be filled at the price that they've chosen and requested. And that's essentially why they call passive orders, because they're not taking any action at the current price level, but they are waiting for their price to be reached. Okay? So any market participants can be passive, essentially. It doesn't matter whether it's a bank, financial institution, the hedge fund, the pension fund, or the retail trader, like, for example, you or me, okay? So the only criteria is that you are entering a position using a limit order, whether it's a buy limit or sell limit order. And it's important to understand that passive sellers, those who use sell orders, need aggressive buyers to come in and fill in their orders. Now, this is one of the most crucial things I need you to understand before we transition to the next slide, and we're going to talk about the formation of the price itself. So let me repeat it. The passive sellers who are using sell limit orders need the aggressive buyers, so buy by market, to fill in the order. So once again, likewise, passive buyers, those who use a buy limit order to be entering the market, they are getting filled by the aggressive seller, by the sell buy market. So buy limit matches with a sell by market, and sell limit order matches with a buy by market order. Okay? So on the other hand, we talked about the passive order flow already. Now, on the other hand, we're going to talk about aggressive ones. Aggressive market participants are traders who enter trades using market orders. If you click buy by market or sell by market, you are automatically acting like an aggressive market participant. Your trade executes instantly, regardless of the current price. Aggressive participants want to enter the trade right now, even if accepting the risk of taking a slippage when the trade is essentially executed at the worse price than you expected. Now, you always need to be able to take into account the potential of the slippage when you are entering the buy by market or sell by market order. That's why passive order flow, so passive market participants, they got the precise price that they requested, while aggressive market participants sometimes get the worse price that they wanted initially. So when you send market order to buy or sell, it gets executed at the first available limit order and the opposite side of the book. That's why the market doesn't always give you the exact price that you see. But we'll go over this in pretty much a second on the example of market auction. Market orders are essentially useful when the price is moving too fast and you are afraid to miss the movement when your timing is absolutely crucial, okay? So the first takeaway from this whole slide that I want you to remember is that buy market order is filled at the first available sell limit order, and sell by market order is filled at the first available buy limit order, okay? And the second important point that we need to remember today is that passive order flow essentially slows down the price or stops the price. And aggressive orders, they push the price, so they move the price. But again, you will see the example of that at the later slides. So let's talk about the market auction and how the price is formed. And for this, we are going to use their easy version, the simplified version of what is called the depths of market. Some of you perhaps heard about it, some of you maybe even using it. And for those who don't, that's essentially something that you will learn today on our today's webinar. So that's a simplified version of the order book. You will see the actual version on how it functions later on the ARAS platform I will show you. And this is essentially the popular tool on many trading platforms that helps you analyze the order flow in real time. And ATAS has even a better version, which we go over it in a later part of our webinar. So for teaching purposes, we'll use a very simplified version of the depths of market to clearly show how the market functions. So one important thing that I want you to know before we're going to get started is the depths of market is a tool that only shows limit orders, so passive order flow. Market orders are not visible here. So you cannot see the market orders that are getting executed, only the pending limit orders that are being placed in our depths of market. So for this lesson, let's imagine that we have only a few market participants and we know all about it, like about every single one of them and where they enter the price and how they enter market. Now, of course, that's not how it works in the real market. That's not the case. But for the demonstration purposes on today's lesson, this example will work perfectly enough. So let's walk through the imaginary situation. Imagine that the market opens at 9 a.m. and the first trader wants to enter a position. His goal is to buy 5 contracts at a specific price, $98 per contract. He doesn't use a market order. Instead, he specifies the price and uses a limit order to buy, which makes him a passive buyer, as we already know. So his limit buy order appears on the bid side of the depths of market. So we have the one first passive trader. Now, a couple of minutes later, a second trader shows up. He wants to sell 10 contracts at a price of 99. He places a limit order to sell, becoming a passive seller, and his order appears on the ask side of the depths of market. So the first trader wants to buy $98 and the second trader wants to sell at $99 per contract. So obviously no trade occurs, right? Because the price doesn't move. Both players asking for different prices, so this does not match. Nothing happens, price doesn't move anywhere, and we continue. A little bit later, two more traders enter the market. Okay, trader number 3 wants to buy 2 contracts at the price of $97 per contract, and another one, trader number 4, wants to sell 3 contracts at the price of $100 per contract. You already can see their limit orders at the depths of market in front of you, but at this point, no one is willing to accept the other's price. So the price stays still, market does not move. All 4 market participants are requesting completely different price and completely different conditions. And this already might lead us to the certain conclusion. If only limit orders would exist, price would never move and the trades would never happen. Okay? So this we already know. Now the trader number 5 comes in. And just like trader number 2, he also wants to sell 4 contracts at the price of $99 per contract. And his order is now added to the depths of market, and now the ask is $99 increases to 14 contracts. 10 from this contract still belong to the trader number 2, and 4 of these contracts belong to the trader number 5. But still, nothing happens, right? The price still doesn't move. However, after a while, that one trader who we've been waiting for comes in the market, the aggressive buyer. As you remember, I'm going to go back one slide, an aggressive buyer uses a buy-buy market order offered by a passive seller. Okay, so he uses a buy-buy market order and it's going to be executed by the first offer from the available passive seller. So our first offer from the available passive seller is at the price of 99 exactly. So the aggressive buyer is going to buy 5 contracts at the price of 99, and this will clear out, remove, fill in 5 contracts from the total available sell orders, so the ask side, and the ask size from $99 per contract is now going to be dropped from 14 to 9, because 14 minus 5 contracts which have been executed equals 9. Now, one thing that it's important to understand is that all 5 contracts came from the trader number 2. So all 5 contracts that were cleared out belong to the second trader because he placed the orders before the trader number 5. So now at the 99 level, we still have 9 contracts left to sell, which 5 of those belong to the trader number 2, waiting to be filled by the future aggressive buyers, and the other ones belong to the trader number 5. And the market essentially works like a queue. Okay, the limit orders are executed in a chronological order, so on the first come, first served basis. And since the trader number 5 placed his order after the trader number 2, he has now to wait until the trader number's 2 orders are completely filled. Okay, so obviously in the liquid market, it's not going to be mostly visible, whereas on the less liquid markets, some kind of stocks, for example, you might really feel it if you place the order too late after the big market participants. Now, let's continue. The current market price is $99 per contract. And because that's the price at which last trade happened, the market stays there for now. Now, let's imagine that the aggressive seller now comes in the market and starts actually moving the price. the aggressive seller wants to sell 3 contracts at the market price. And as you already know, because we talked about this in the beginning, sell by market order is executed at the first available price from the passive buyer, meaning the nearest buy limit order. And where is the first buy limit order? Well, on the first available bid size, which is the $98 per contract. So the aggressive seller sends a market sell order and the passive buyer picks up the order at $99 per contract. And since the buyer's limit order was placed at 19.8, the price now drops in order to fill in the market sell order. As a result, the aggressive seller sells 3 contracts, which fills 3 out of 5 buy limit orders that were originally sitting at $98 per contract. Now there are only 2 contracts remain at this level, and here is something important that I need you to know and notice before we're going to move forward. The price dropped even though the number of buy and sell orders was exactly equal. A common misconception among traders is that price moves up or down because there are more buyers or sellers at this moment. Now, that's completely not how it works, because the price went down in this example despite there was 1 buyer and 1 seller. The price went down because the sellers were more aggressive than buyers. So the number of buys and sells is always equal. Every trade has a buyer and a seller on the opposite side. What really matters is who is more aggressive in this moment, the buyers or the sellers, and that is going to determine where the price is going to go. Okay? Now, what needs to happen for the market price to change from 98 to 97? Well, that's very simple. For the price to drop, more aggressive sellers would have to come in and take out 2 remaining orders, buy limit orders on the bid side, which is $98 per contract. In this sense, we can say that limit orders work like a barrier or like a quote-unquote wall. In order for the price to keep moving in a certain direction, this wall has to be broken. And here is a key takeaway that I want you to remember or maybe write down, right? The limit orders stop the price and the market orders move the price. I said it all the way in the beginning of the webinar, but hopefully right now, up until this moment, you already have a visual example of how it works. So again, market orders move the price and limit orders cause the price to stop. Now, with this out of the way, let's move on to the next example. Imagine that another aggressive seller comes in and wants to sell 3 contracts at the market price. Right now, the price is $98 per contract. And there are only 2 limit buy orders left at the price of 98. And that's not enough to fully fill in this market order. So what's going to happen? Well, 2 contracts are going to get filled on the price of 98, clearing out the wall of remaining buy limit orders. But 1 contract is still left unfilled. And since there are no more limit orders available at the price of 98, the price has now to search for the next available price, and that's the price of $97 per contract. The remaining 1 contract is going to be filled at the price of 97 by a new limit buyer. So this aggressive seller caused the price to drop from 98 to 97 because his sell order was executed across 2 different price levels. 2 contracts at the price of 98 and 1 contract at the price of 97. Now pay attention again to something really important. The price dropped for the full 1 point even though there was only 1 seller and 2 buyers. So we even had more buyers than sellers, and the price still dropped. And this once again proves that the price movement is not about the number of orders, but not about a number of sellers or buyers, but about the imbalance of aggression between buyers and sellers. Now let's have a look at the 98 level. There are no more limit orders left there. And as you remember, or you know by now, that market order doesn't specify the price. It simply executes at the first available limit order. So where is the next available sell limit order? The next available sell limit order is at $99 per contract. And at the 98, we have no liquidity, no limit orders. Now imagine that an aggressive buyer enters the market and wants to buy one contract at the market price. The current price is 97, but there are no more limit sell orders at the price of 97, and there are no more limit orders at the price of 98. The nearest available sell limit order is only at the price of 99, and even though the current price is 97, the aggressive buyer's trade will be filled by the $99 because that is the only level where the seller exists. As a result, the market instantly jumps from 97 to 99, and this is what we call, apologies, a gap. A sudden price jump to 99. So essentially, the price gapped and the buyer experienced a slippage. He was hoping to be filled by 98 at the very least, but there was no liquidity there, so his order jumped all the way to the $99 per contract. This means that he got the worst price than he was expecting in the beginning when he was sending this buy-by market order into the market. So in this situation, again, we had one buyer and one seller, yet the price jumped 2 points. And that's what we've said already before. Aggressive orders move the market. Passive orders stop the market. And if there is a wall of limit orders, or if its limit orders wall is not strong enough, like in this example, the price simply jumps to the next available liquidity level. Now, the final scenario, because I know it's a lot of numbers. Let me know in the chat, please, if you are with me, if you are paying attention, if everything is clear. And we're going to cover the final example right now. Okay? So imagine that there is a large market participant who is entering the market. Clear. Thank you. Thank you for the feedback in the chat. I see it. Fantastic. Thank you. So let's imagine there is a huge trader, well, for our example, right, enters the market, and he wants to buy 15 contracts. During this time, some new passive sellers have entered the book, and I already added the limit orders into the order book. The current price is 99. That's the level the trader sees when he decides to send his 15 contract buy-by market order. Since he uses a buy-by market order, he is an aggressive buyer, and him sending this buy-by market 15 contract order is going to cause the price to jump from 99 to $103 per contract for the full 4-point move. Let's now have a closer look at how this order was executed. 8 contracts were filled at the price of 99, but there was not enough liquidity to satisfy the full 15 buy-by market order. So the price has to go up. It goes up, and 3 contracts were filled by the price of 100. There was still 4 buy-by market contracts left. The price goes up. The 1 contract is getting filled in by the price of 101. Up, 2 contracts are going to get filled by the price of 102. And the final 1 contract was filled by the price of 103. And even though the total number of buy and sell contracts was equal, so 15 contracts to buy and 15 contracts to sell, the price still moved up significantly for the whole 4-point move. Why? Well, because the aggressive buyer's order size was larger than the available limit sell volume at any of those price levels. Okay, so the wall of limit orders wasn't strong enough to satisfy this one aggressive buyer. In reality, though, the large traders usually don't use a market order like this because their big size can significantly get a slippage, or they're going to essentially move the market drastically, right? They're also trying to cover their big orders, so they usually divide them into the pieces and use actually the limit orders. But for this example, right, you essentially had this example to just understand how the market auction works. And that's why it's also important to trade the liquid markets, because the higher is the liquidity of the market, the tighter is the spread, and the lower is the risk of the slippage when you are actually entering the order buy by market or sell by market. Now, let's summarize a couple of key points before we move on. First, price moves based on the interaction between market orders and limit orders. Limit orders, the passive order flow, is like a barrier, while market orders break through those barriers or walls, however you want to call it. If a limit wall is too weak, price simply jumps to the next available level of liquidity, so the next available limit order. And aggressive orders, again, move the market. Passive orders stop the market. These all principles are absolutely crucial to understand, especially when you analyze volume profile, footprint charts, depths of market, smart tape, and so on and so on. But before I give you the practical trading tools that we're still going to cover today, I want to explain a few more price formation concepts. So please make a note of these key terms: ask, bid, and volumes, because we are going to need them today to go through a couple of tools. So we've already seen them in the DOM, depths of market, and the market is built around two sides, the ask side and the bid side. Ask normally includes buy by market orders, buy limit orders, and stop losses of sellers. Obviously, also the take profit of sellers, but let's be clear, the percentage of the traders who actually lose their trade is much bigger, so the majority of the volume is going to come from the stop losses, not take profits, unfortunately. And we have the bid. Bid includes the sell by market orders, the sell limit orders, and stop losses of buyers, and also take profits of buyers, but again, that's a smaller percentage of the total volume. Now, you might ask why the stop losses of sellers or buyers, and here is why. Because for those of you who are just starting, right, trading and diving into derivatives, the short trade, so you sell to open, right? The only way to close the short trade is with a buy order. So if you're in a short position, your take profit and stop loss will be buy orders, which means they're going to be executed at the ask price. And it works the same way in reverse. So for long positions, when you are entering long trade, both your take profit and stop loss orders are going to be sell orders, which are executed at the bid side. Now, how are the trades essentially closed, filled? We already talked about. And to summarize a couple of key points before we're going to transition into the practical part of our today's training is the first: a buy trade is closed by executing a sell trade. A sell trade is closed by executing a buy trade. Closing a trade, whether by stop loss or take profit, is considered a separate transaction. That's important because it's going to be separately counted into the total volume. And price moves when market orders absorb limit orders, while if there are more limit orders than aggressive market buyers or sellers, the wall of orders can stop price from moving further. So every time you see the price slows down, you now might think about it. There is a wall of sell limit or buy limit orders that is potentially stopping the price from moving further. Okay, so all these processes that we went through today already, from aggressive market orders to reaction on the limit liquidity, are just not theoretical. They can actually be observed in real time, and that's exactly what ATA's platform allows you to do. So it includes different specialized tools that help visualize the mechanics of the price auction theory in details. So let me show you exactly how can you see it on your trading platform. And to bring it all together, those are the tools that we are going to be discussing today in one complete picture. And then I'm going to go and break them down one by one. But for now, let's actually compare them side by side before we're going to transition into the separate discussion of all of those. So each tools that you see shows a different aspect of the same process, order execution in the market, but from the different perspective. The smart tape shows you what they are actually doing right now. So what traders are doing right now. The executed market trades, who bought or who sold and at what price they did it. And how it's going to be used, it is used usually to track the activity of large players or their liquidity and the volatility of the market. Now, next, the depth of market lets us see what participants intend to do. And in the previous slides, you saw the simplified version of the depth of market, but that's essentially how it works. We're going to go through the real version, but you will see the limit orders that hasn't been executed yet. And it's used to identify levels where price might pause or might reverse. Those levels usually also act like a magnet for the price. And the final one is a footprint chart. The footprint breaks the candles down to show the volume traded at bid and ask on each price level, or you can change the settings to a different perspective. I'm also going to cover it later. And it's used to analyze intra-candle strengths and weakness and the disbalance between asks and sells at each price level. Together, all three of those provide almost like an X-ray-like view on how large players behave, from their intentions on what they are planning to do, to execution, which trade they already executed, and the final outcome of the disbalance of buyers and sellers. So now let's switch over to our ARAS platform, and we are going to have a look at the first thing of how those tools work live. And just let me remind you, if you have any questions during today's stream, during today's webinar, please keep them till the end, or if you can send it already in the chat, but I'm going to cover them all in the end. So all the way in the end of the webinar, we're going to have 10 to 15 minutes to go through all the questions, and I'm going to answer them to the best of my capabilities. I don't know everything about the market, but I do know some things that help me trade, and I do hope that they are going to help you as well to understand your trading better. So let's go step by step. And let's start with their smart tape. We're going to start with the smart tape tool, which you can see in front of you. Here, I'm going to separate it so you can actually clearly see it on the full screen. There we go. So to understand and read smart tape effectively, you first essentially need to understand the core principle behind every single exchange that you trade. And the price principle is simple. The exchange is simply an auction. So just like we had a look at the depth of market example, that's essentially how the price works. So if there are lots of motivated buyers at the auction, the value of the product goes up quickly. If the auction is dominated by the other side, by selling pressure, for example, and there is lots of supply, the price goes down. And all executed market trades and their details can be viewed from smart tape in your ARAS platform. The one line represents one simple trade. In the standard tape, we typically see there some things like, for example, time. So essentially the time when the trade was executed, the price at which the trade was executed. Then you see plus or minus, which means essentially whether the price ticked up or ticked down and how many ticks it ticked up or down after this specific trade. Pluses and minuses, keep it very simple to understand and analyze when working with lots of different data. Next, the volume of this specific trade. So you can already see something that stands out, the 10 contracts, right, across lower amounts. So that's essentially what smart data is used for, to find the unusual market activity. Then you see the bid price. So on top, you can see the best price available to buy after the last order was already executed. Then you see the ask price, so the best available price to sell after the order was executed. Then you see the essentially buy and sell power indicator, which is extremely useful, and the speed indicator, which shows the activity level of their tape. Now, I'm going to go briefly through the smart tape settings with you, so you know how to set it up. But those templates that I'm using on today's webinar are going to be available to download and use in your Anas platform right after the webinar is going to be finished. So you are going to have this pre-set up, and you are going to have something to work with already when we finish the webinar today. So first of all, you can actually add or remove certain lines. So if you want to add certain things or remove certain things, you can actually do so. So to add or remove certain functions, right, you can actually go through the settings here and change the visual settings. If you want to work, for example, with a darker background, I know that some traders prefer working with a dark background. For myself, I prefer the light one because my eyes are going to get tired less like this, and I'm going to be able to work and focus for a prolonged period of time. You're going to be able to change the buy and sell colors, the fonts, and all the other visualization aspects that make it more useful for you and more comfortable for you to work with. You can also filter out, for example, you can unclick and click the cumulative ticks, okay? Because right now what we are looking at is the smart tape, which is an enhanced version of the classic time and sales window. So in other trading terminals, you're going to have the classic time and sales, but Anas developed what is called the smart tape. So unlike the standard tape, the smart tape can group, filter, and highlight important trades, so we as traders can focus on the truly meaningful actions of major market players. And here is what smart tape actually especially is useful for. First, it groups, like you see in front of you right now, the trades by price level when they occur within a small time window. So for example, if one large market participant sends a buy market order that gets matched with many different sell limit orders, the standard tape would display dozens of separate rows in front of you, making it very hard to analyze such a big volume of data. Smart tape consolidates these things and cumulates the things into one row, clearly showing the overall size and the direction of the market. It also filters out the noise, leaving only what is actually important to impact the market, and it visually highlights large orders, spikes in activity, for example, and helps quickly identify major player behavior. So you can unclick, but I suggest clicking in the show cumulative ticks. And right here, you can also choose the minimal volume. I do not suggest using the maximum volume personally, because that's not the point. The same here, neither for cumulative or separate trade filters, but the minimal values actually can be quite useful, because right now we are looking at the smart tape of the silver futures. And if I'm going to put, for example, minimal volume of 10 cumulative trades, then what we see is that's going to bring the smart tape much down. So right now we can actually see at which price levels there and what are those buys or sells that were executed with a large, pretty much large orders. And this helps us to filter out all the other noise that is happening from the smaller market participants. But for now, I'm going to remove it. But again, I do not use maximum volume filters. I use the minimal volume filters for myself. And the minimal volume filter is going to depend on the asset that you actually trade. Next, you can go to the alerts. And you can set the alerts when the unusual activity that you are looking for happens. which extremely is helpful essentially when you trade and you cannot focus on all the confirmation that you might use for your trade ID. And you can set alerts even on the smart tape and others. And I use it lots, like every single day in my trading, because you can actually filter out some things. You can help yourself to get a better grasp on what's happening in the market. And then the templates, that's where you will be able to upload and use the template that I'm going to share with you after today's webinar. What is also useful is that you actually can freeze the tape using the snowflake on the left upper corner. And this is especially useful when you want to analyze a specific trading situation. So for example, you notice something, but the tape is moving fast. And to not lose the side of it, you can freeze the tape, it's going to stop moving, and you can analyze what's happening. You can also pin this window on top of your already existing window to make sure that the data remains visible and doesn't get hidden during the rest of the analysis. So how do we analyze and use this smart tape in your trading? Okay, so first things first, how I personally use it is spotting activity spikes. So if you see several large orders in a row, which essentially smart tape also accumulates for you, so it's much easier, moving in the same direction, approximately the same price level, that signals of the start of the impulsive move. So to help you with this, again, you can actually go to settings and you can use the minimal volume filter on the cumulative trades or separate trades, depends on the asset specification that you trade. You put in specific volume filter that you use based on the asset. Again, it's going to be different because of different liquidity in different markets. And it's going to help you to highlight only large, unusual trades. And you will be able to analyze which percentage of those goes up and down, what are those buyers or sells, and which percentage at which price levels, for example, of buys is executed. So you can see the potential start of the next impulsive move. This doesn't happen often, as you see, because if we filter it out, for the past 40 minutes, we only have so many cumulative trades with a volume of 10 or more contracts. But if this does happen, right, that's something important to have to keep an eye on. And alternative, of course, to this is to leave the filter off and simply watch the size of trades manually, row by row. So for example, if you see 5 consecutive rows at the same price with a very high volume, for example, several contracts in a row together, right? And you will be able to see all of them are buying at the ask, that likely means that someone is aggressively entering long and a move may be starting. And the most important thing, personally, from my own perspective, if we are talking about smart tape, is this speed indicator. First of all, and essentially speed indicator can help you to see the volatility of the market, and it is especially useful when trading stocks or other less liquid markets. Because if I would bring up here the currency future, you wouldn't be able to use the speed indicator to its fullest potential because it's quite a liquid market. Now, if you're using, for example, to trade the stock market, it can help you to separate the stocks that might be worth attention from the stock that are better to just be left out, at least for the current moment. By watching the pace of the speed tape, you can see that if tape speeds up, the speed indicator increases. You actually could see it a couple of minutes ago when I was talking, the speed went like up, the whole speed was getting blue, right? That means the speed indicator speeds up, so it increases. This means that the pressure begins building on either ask or the bid side, and this signals strong aggression. And how to know whether it's building up on the build or ask side? That's by filtering out and looking at which prices were the most volume executed, and either it was on the ask or bid. And you can also use a buy-sell power for this purpose. So For example, if you see this kind of active, fast-moving tape during the pre-market on the stock market, it's worth keeping an eye at this instrument for the upcoming trading session. And on the other hand, if the speed slows down or becomes essentially, almost empty, it might mean that the interest in this specific market is dropping. So no active market participants also means there is no money in this market. And if there is no money, there is no volume, and there is no opportunity for you as a trader. So those are not the instruments that you want to be trading. I focus on the stocks and markets which are actually quite liquid, and either the speed is constant, and for stocks is better when the speed is increasing. That's where you can find the most interesting opportunities. So if you're a scalper also, you can enter on the impulse if you see a series of large trades. Again, you can use a filter for this, right? You can use, the cumulative trader, for example, filter. Let's drop it a little bit by 7. And if you see the impulse is happening and the series of large trades is coming on one of the sides of the side of ask or bid, and you can see the speed increasing at the same time, and the buy-sell power is confirming the same direction, you can essentially use this as a confirmation to get in the trade. So instead, if you see the heavy selling, so for example, you see the lots of volume is executed in the big orders on the bid side, and the buy-sell power is pressing on the sell side, so the black is coming more visibly, and the speed is also increasing, that essentially shows you the short momentum, the selling momentum, and you want to look for the sell opportunities. You can also use the tape as an additional filter to validate your entry setups. So if you already have specific entry point that you want to see the price, for example, reversing from, when price reaches this reversal zone, you may enter the tape and see the confirmation if the price is actually reacting, if market participants become more active, if one of the sides take over. And if you see the activity confirming your idea of the market reversal, then you are going to more confidently be able to enter this trade as well. So to sum it all up, the purpose of today's session is not to give you their specific strategies to, use a smart tape. That's something that we are going to be doing in the later webinars, but to give you an idea and understanding of how to read the order flow and which instruments are there in Anna's platform as well that can help you to read the order flow more clearly. So to sum it all up, before we move on to the next, and next is going to be the depths of market, smart tape is convenient and essentially an intelligent tool that shows you who is being more aggressive, buyers or sellers right now in the market. Where is activity spiking and how you might as a trader respond. It can show you the most interesting levels in the market. And when you combine it with depths of market and the footprint charts, that can become a powerful decision-making tool for yourself. And that's exactly what we are going to be covering next. So we covered our smart tape. I'm going to combine it with the rest of the tools, and we are going to go to the depths of market. Let me bring it to the full screen as well, so you can clearly see it in front of you. Yeah, for those of you who are entering later, in the end of today's webinar, we're going to have 10 to 15 minutes to cover the questions as well. So I see all the questions, and I'm going to respond it a little bit later to make it more comfortable as well for everyone. So what we see in front of us right now is an actual depth of market. So before, we were learning the market auction theory is based on the simplified version of this very tool. And the depth of market is also known as an order book. And it's a real-time display of all pending orders to buy or sell the asset that you are looking at. It shows only the limit orders, I want to remind you, that have been placed, including both pending, essentially buy limit orders and sell limit orders. So this reveals what hasn't happened yet, but what might influence the price in the future. And I hope one of these levels that I see right now is going to stay, because that's a perfect example of what I want to cover today. So while the smart tape that we were talking previously about shows us something that has been already executed, the depth of market shows us the intention of market participants, what they want to do. Inside the depth of market, we see limit orders waiting to be filled. At the top, there are the limit orders. We have the buy limit orders, right? And we have the price, which is showing the current market price right here. It jumps, right? We have buys, we have sells, and we have right now this specific template, which you are going to also be able to download after our today's webinar. You see the histogram on where the majority of bid and asks are placed, which is extremely useful. I really love this tool in others. So it helps you to visualize these liquidity walls that we are going to be talking about, the large limit orders sitting at the specific price levels. Typically, the depth of market provides us the information about different securities. And, I usually use it for my futures, like, for example, commodities, oil, gold, silver. I use it less at the market, for example, like liquid markets like 1, 2, 3. I'm trying to translate this word in English. Currency futures. The English is not my primary language, so I hope you guys understand everything that I'm saying today's webinar. I'm really trying my best to explain the difficult topic in the simple language. So I do hope you are getting those. So I do use it less in the currency futures market, because again, it's a very liquid market and I find it working less there. But if you go to the commodity market, if you go to the indexes futures market, if you go to the, for example, stock market, all of these tools are extremely useful. But if you are looking at the depths of market, even if it may seem very easy, it's actually not so straightforward on how to trade directly from the depths of market. The key here is not to be looking on how many orders are sitting there on each price level, but to actually analyze the behavior of market participants. So first of all, what you can be looking at is the liquidity walls. That's one of the best things that I personally look at. When you see the large limit order at a certain price level, for example, like here we have the 433 contracts left at the bid side, which definitely stands out of all the rest. As we can see, the average is about 150, whether it's at this one price level, which you see in front of here, which is 30,220, we have 433 bids left. So this could mean that price may essentially gravitate toward that wall, which we saw just in front of us. The price was here and it was slowly dropping to this specific liquidity wall. And because there is a clear interest there, right? We need to understand one key principle. The orders in the market, the pending orders, are the money in the market. The money is market's fuel. If there is money somewhere, the market will go there to grab this liquidity, or at least there is a very high chance that it will. So when you see this kind of liquidity wall, first of all, it may mean that the price may be going towards it. And secondly, it may mean that the price may bounce away because of the large participant is blocking further movement. Sometimes traders use this kind of level as an entry point for a trade, which I personally do not suggest, because the large limit orders sometimes may simply disappear from the depths of market. So this could mean one of the two things: a manipulation tactic. So they show the size to essentially, to attract the traders, but they pulled it away the moment the price gets closer there, or simply the loss of interest. So if the position, gets closer to this level, but the market context changed, the price may just fly through those liquidity walls. So how I use it in practice is that if you're a scalper, for example, you can enter near these liquidity walls, but it may be risky. So if there is a large limit buy order, for example, you can go long all that with a very tight stop, or you can exit quickly on a small impulse. But what is I find more effective is to enter when this order is removed. So, for example, if the big limit order disappears, it opens the door for the continuation of the price movement. So when the price comes closer to the order but flies through it, the order disappears, you may enter for the continuation of the symbols. Okay? And for intraday traders, you can use the depths of market to confirm levels from your volume profile. And volume profile is something that we're going to be covering in the next webinars. So for example, if you will identify the point of control at a certain level on the volume profile, for those of you who perhaps already used it, if there is a large limit order at the same price level or very close to it at the depths of market, it reinforces the significance of that specific zone. So both scalpers and intraday traders can be using the depths of market for, to enhance their trading strategy and decision-making process. But one thing that I need you to remember is the depths of markets is a very fast-moving tool, right? You need to be able to react very quickly, and it updates frequently, and it doesn't always give you a clear signal. But when you combine it with, for example, volume profile analysis or TPO or the footprint charts, this can bring you something very helpful, additional confirmations for your entries. So next, we are going to do exactly that. We're going to try to bring it all together, and I'm going to show you how it works with something that is called the footprint chart. So let me switch over to the footprint. There we go. Let me confirm that it works. Yeah, you should be able to see that perfectly. So that's one of the most powerful tools that I find personally for my own trading, and that's footprint charts. Many traders use classical candlesticks, just like this, the Japanese normal candlesticks, and they show us high, low, open, and close for a given time period. The footprint is like an X-ray of that candle. It reveals you what actually happens inside of each and every single candle. So at which level volume was concentrated, how many contracts were bought at the market ask or sold at the bid, and where the spikes in activity occurred, as well as who won the battle, sellers or buyers. So let me show you how it looks like. So that's an example of standard candlesticks, right? And you can auto-transform them into the clusters. If you set the settings in your ARAS platform, you could also essentially zoom in the chart, even if you are on the candlesticks, standard candlesticks. And if you just want to clearly see the activity very quickly, you can zoom in and you can scan the candles at the point that you're looking for the price reversal or the price continuation, which I also find extremely useful. So, and each price level and each single candle, you can see how many contracts inside of the candle were bought and sold. Right now, I have a filter set for the bid X ask, which means on the right side, we see the asks by traders, the aggressive buyers, all the asks that were executed. On the left side, we can see the all sell trades that were executed by the bid side of the order. So those are our aggressive sellers and everything that was executed on the bid side. So for example, if we see a very large bid, like for example, well, that's maybe not the biggest one, but a quite one that stands out, okay? So we can see that the price, the large imbalance of the bid was formed and the price continued to move down. Now this level may continue to act as a resistance, because we did have quite a significant amount of sells, so the bids traded at this specific price level compared to their average amount of bids and compared to the amount of asks as well in this specific price level. More about footprint charts, we're going to be still talking later in our next webinars, and I'm going to be showing you some strategies to trade with a footprint. But essentially, you can select different filters. So again, you can select simply bid and ask, but I find the most useful to have the bid and ask delta colored, where you can see the disbalance between the bids and asks on each single price level. If you go into the settings, you will be able to visualize your cluster settings in the most comfortable way for you. So you can change the colors here, and the most importantly, you will be able to go lower. That's a text size and the text color also. But the most importantly, you will be able to find the proportion settings here. Now I use the whole chart, so it takes the whole chart and selects the important levels and that are outstanding from the average. So outstanding disbalance between asks and bids, and outstanding amount of asks and bids. And the higher is the disbalance between asks and bids in every single price level at every tick, the brighter the cluster will be. If I drag this to the left side, you will see that it's going to filter out even more. If I drag it to the right side, you will see that clusters become brighter. You need to find the proportion settings that works for the market that you trade. I know some traders also do use the visible region. I, for myself, prefer the whole chart, but you can adjust it to your own preferences. Once again, you will be able to download this template and work with it after our today's webinar is over. So that's something that we're gonna that's something that we're gonna be talking also about on the next webinar, where I'm gonna be showing you some strategies using the footprint charts. Next, the bid and ask imbalance settings. As you can see, I have it enabled, and I have both bid and ask color set for the orange. That's something that you can change. Now, what it shows is the disbalance between the asks and bids diagonally, how the footprint is red, and it shows you where the imbalance were formed. Now, that's something that I'm going to change. I use the 300 imbalance rate, which means it's going to highlight the levels here where the bid or ask is 3 times or more higher than the previous ask or bid diagonally. That's something that also you can use for trades, for entry points, and also for exit points, as well as a magnet for your price. And that's something that we're going to be covering as well in the next webinars. I'm going to show you some other things. Is that if, for example, that's something that we want to find in the footprint chart to give you an idea of what we are looking for. If we look at the statistics, right, we will see that we had barely any volume in the market. Here is something, but the level and the zone which stands out is right here. So a very prolonged period of time from the whole London session until pretty much the end of the London session, we had barely any volume volatility, while right here, we do have the very important zone. It highlights for us that we had a very big disbalance on the ask size. First, so we had the 3 quite important bright green deltas and 2 quite important red bright deltas, which first of all means for us that we had quite a big activity going on in this price. And what I look at next is where is the next candle going? Since the price went up from this zone, I'm going to be looking to long it, because the traders, big market participants who entered the market at this zone are going to be more likely to protect the price, these levels, when the price returns to this, because otherwise their positions, which are just recently opened, are going to go in the drawdown and in the negative, and that's not what they want. So when the price closes up the next candle, and I'm using 5-minute candle example here, I'm going to be going long here when the price comes to 1 tick above this zone. So here, well, it wouldn't grab it, but we can see the reaction, right? The price came to this zone closely and bounced back above it. We can see that if the price, it still came here closely, and for the push the price lower, we needed to have more activity for market participants. So for the price came back to the zone, it was trying to push back to the upside. So the buyers were still buying here, and then they started to close their orders before the next push. We see some bright deltas appearing here and there. So when the price consolidates at the previous bright level of delta, that's your sign to get out of the market, because it usually means the accumulation of volume which is prepared to push through the wall of orders. Okay, so that's next. Now, what next? We see the bright gray, red delta here, and the price went up. This level can also be used as the price, that's something that holds the price. And I like talking about the price not as a level, but as a zone. So when it gets closer here, I'm going to be looking for the buy, and that's essentially would already be the reaction that I'm counting as a reaction to this bright red delta as well. So, but more about the footprint charts we're going to be covering also in our next lesson. Here is another example of the bright deltas. We had one red one, bright one, and then the price dropped, which later worked out as well as a price reversal here. The same as when the price was getting closer, we did have some disbalance on the ask sides as well, and the price did drop afterwards from this whole zone here, so that it was used as a confirmation also to enter. Again, if you have any questions in the details, please, already can start writing them, because we are getting closer to our today's webinar. But the other useful filters and settings that you may be using for your footprint charts, for your footprint settings, is the following. Let me go back to the other chart. There we go. So the other things that you may be looking for is, besides using the bid and ask delta colored filter, you can also filter out your footprint by volume or by the amount of trades. So that shows you where the biggest activity of buyers and sellers were happening. So where traders were more active, at which price levels, which essentially covers the zone of interest both for buyers and sellers. Or you can filter out it as a volume. Now, for the assets like, for example, gold, silver, mini S&P 500, mini Nasdaq 100, Russell, Dow Jones, and currency futures, I use the delta filter. If we are talking about stocks, if we are talking about oil, I do prefer, that's my personal preference, but I do prefer using the volume filter, because I find those assets react better to volume than for the disbalance between asks and bids. So that's also something that you can be using. That's a filter on the on volume, and that's a footprint on the 15-minute candle. So that you can use to determine if the price is going to reverse. And with a combination of the volume as well itself, you can find their standing out situations. Like, for example, this one, as we can see, the unusual market activity. I do have the volume placed, the filter on the volume placed as well here. And that's just one of the small parts what we are using. But we see the spike on the volume unusually standing out of the rest. And then we see on their footprint chart, on the volume footprint chart, the majority of the volume was concentrated at the bottom. Then price jumps from there. This zone can be used as an entry point. And right here, we see the price returns to it and goes up for hundreds of ticks from this level. That was like more than 100 ticks to the upside. So that was just one of the examples. The unusual volume activity concentrated in one side of the candle. So either up or down, depending on the situation. And then confirmation from the volume indicator itself. That's a normal vertical volume just with a filter in it. And right now I have a filter on it set to not lie to you, to 10,000 contracts. That's specifically for 15-minute chart on oil. And we see the same exact situation here. Now, I do prefer when it's on the one of the size, and I do prefer when I do have confirmation from the volume indicator as well. So here we had the activity accumulated at the bottom, but the price even reacted to this, but I wouldn't be entering here personally because I did not have the confirmation from the volume indicator. So there was no volume that was standing out from the rest. It was gradually building up because it was getting closer to the market opening for oil, and that's not something unusual. This already is. This is not. So I hope this gives you some kind of understanding as well. So mini strategies that you can use for your footprint trading is, first of all, the volume spikes, like here, right? Delta extremes that I showed you before. So delta extremes like this, for example, or like here. You can also use it simply, for example, to introduce you to these tools and see what those tools, smart tape, depth of market, and footprint charts are capable for. And if they are combinable with your trading system that you are already using. In our next webinar, we're going to dive deeper into the footprint charts, as well as strategies involving bid and ask imbalances. So I'm going to talk about imbalances and cluster analysis in depth. So before we transfer to our Q&A, a little summary. We today covered how price is formed and how to actually see this in action using 3 different tools in Ada's platform: the smart tape, the depth of market, and the footprint charts. And understanding all of those essentially helps you to start seeing trader behavior. So you can build more accurate trading system and feel more confident when you enter the trade. Once I started to understand the market auction and what is happening behind the candlesticks, I stopped guessing and I started to feel more confident about what I actually see and what it means in the market. And I do hope that it also helps you to feel the same. So I'll return to the chat now. If you have any questions or if there is anything that unclear or you want to ask, please do this now. That's a perfect time to ask questions. Let's have a look at this. There is a question: how to show candle wicks on footprint charts? Well, that's fairly simple. If you zoom out, you can see the wicks here. The wicks are not going anywhere. The wicks are essentially the high and low, how far the price dropped to how far the price went up during the candle formation. But on the footprint charts, that's going to be exactly the same, right? Now, what you see here is this is the candle, the body of the candle. On the left side of your footprint chart on Ada's platform, you will be able to see this candle here. So if the body of the candle is only on the top of the footprint, this means that all of this on the bottom is the wick. The same here. You can see the bullish candle, which is represented for me as a blue. You can change the colors. And bearish candles, which are represented as black. And as you can see, the blue candle here has a body of the candle from 30,180 to 30,115, and everything on top is the wick. So that's essentially how you determine the wicks. What and who made you start trading? Good question. No one made me start trading. I just wanted, that's gonna sound really cliche and really cheesy, but I just wanted freedom, which obviously was much more difficult than I expected. Trading was much more difficult than I actually expected when I started it, but I simply wanted freedom, and that's where I went to learn how to trade. I started with crypto, and then I transitioned into forex, and then I transitioned into futures later on. Thank you so much, Dave, for the feedback. Okay. Well, perhaps because you are trying to search the CFD assets, and ADAS is a futures trading platform. So you do have the currency futures, you do have 6E, which is a Euro futures, which is an alternative chart to Euro USD, and you do have gold, which is the code for the gold is GC. But I do suggest to learning the basis of futures before learning to trade footprint, smart tape, and depth of market as well. Average is the average amount of volumes that was traded at this level 1 second. Here, you're asking about this is an average amount of contracts because it summarizes it and accumulates it together. Your footprint candles, Louis says, don't show the bid and ask. What's the setting to add them? That's something that you can just change when you choose your footprint chart here. On the left side, when you chose the footprint chart, you will be able to select how you want your footprint chart to be calculated. If you want to see that bid and ask, you need to click on the bid X ask, and then you can select here bid and ask simply with an empty candlestick. Then you can see the delta colored depending on the disbalance between asks and bids. You can also see, for example, histogram, the ladder, right, and volume profile, and all of these kind of things. I suggest using either the volume profile or the delta colored. That's the best thing that I can suggest you doing. And now we need to go and change the settings. And here as well, you will be able to change it to the volume, amount of trades, or simply delta without bid and ask. There we go. Let me go back to the questions. Asks are buy by market, sell by market, and stop losses of sellers. This refers to the chart that you see in front of you on the footprint. So what is traded on the footprint and what is shown in the footprint. And it, as far as to my understanding, it was not false. And volume is a summary of asks and bids. So essentially, if you go here, you see the delta. So the red cluster is the disbalance on the bid size. So you will be able to see more bids than asked in this specific cluster. The opposite happens with the green cluster. So if the bright green cluster occurs, you can see that there is 28 asks and 0 bids, which is why it is bright green, because we had far more asks than bids, and that's the disbalance on the ask side. Now we have, if you select the volume is going to show you the summary of asks and bids. So the delta is ask minus bid, the volume is ask plus bid, or bid plus ask. The volume is a summary, and average is the average division. 3 favorite trading books? Easy. One Good Trade. One Good Trade is probably one of the best. What I've Learned Losing $1 Million. Really suggest you reading it. And Best Loser Wins. I do not suggest reading, I don't personally recommend reading trading books on technical analysis because I don't find it useful. But I do like reading trading books on the prism of mentality and psychology of traders. This, to a certain degree, may help you to learn on the mistakes of others and not your own. Okay, let me go through. Through the previous comments as well during the webinar. Tim was asking during the webinar for ticker line, ticker like ES, does it make sense? I do find it that it makes sense. Yeah, I really do find it that it makes sense because you have such a big amount of data that is going to be much more easy for you to filter it out and focus on the important if you have the minimal value filter. So Timo, I do find it really useful. For those of you who are here, you will be able to rewatch this webinar as well if you want to repeat it at any point. Is order flow useful in trading crypto? I personally don't trade crypto right now. I transitioned to the futures market on the CME and stocks, but it is useful. It's the same principle. The market auction theory and the price formation theory is exactly the same over the different kinds of market, and it does apply also to crypto market. Okay, and there was also a question, is the smart tape the new strategy? Well, the smart tape you can implement to your trading system or not. Depends on your trading system and what you find useful. I find the most useful footprint charts and depth of market. The smart tape I personally use less because I do find it too fast for my own trading style. But it depends on the trading style that you use and the approach to the market. So that depends on you. I do hope today's webinar was helpful to you. And today we covered essentially one of the most fundamental topics in trading, the price movement mechanics. So most importantly, we didn't just talk theory, but we actually observed how the market participants behave in real time. We did have some examples as well during the smart tape and depths of market as well. And we explored the three core tools down the Anthos platform, which is the depth of market, smart tape, and the footprint charts in the different representations. Together, all those three tools give you the deep picture of trading and what the market participants are doing, both big market participants and small market participants, like all of us together here. And that is a true power of the order flow analysis. We essentially also discussed how to use these tools in scalping and intraday trading, and to filter out trades, for example, find entries, spot potential reversal zones. And on the next webinar, we are going to talk closer about the asks and bids. We're going to talk closer about the footprint, different strategies. I'm going to show you a couple of strategies that you may apply immediately, straightforward after our second webinar. And exactly in 1 week from now, we're going to see each other again, and we'll move on to our next topic. Thank you so much. I see all your comments. Thank you so much for being here today. Yes, you can trade gold futures on ATAS. And even better, once again, you will be able to download this basic templates that I've used today to represent the depths of market, smart tape, and footprint charts in the description to this video. After the video is finished, give us a couple of minutes and you will be able to download the file with those templates. So make sure to download ATAS, install it today, and you're going to have the free trial as well, where you will be able to use those tools to better your decision making in trading. Thank you so much for being here today, for your attention, for your time, for your comments, and I'll see you soon on the next one.